With economic headwinds growing stronger every day, more and more investors are looking into ways to protect their hard-earned money from the possibility of a recession. Many remember the losses they or their family members experienced during the 2008 financial crisis, and they're determined not to suffer the same fate. But for those with tax-advantaged retirement accounts, such as 401ks or IRAs, the question becomes, where do you move those assets before a recession strikes? Because if you don't take action before the next downturn hits, the damage may already be done. The problem is, trying to invest in assets that are going to gain value during a recession can be difficult. For most investors, they're simply looking to minimize losses. But we have a solution that could potentially do both that we'll cover later in this video. You could also think about the tax implications with moving money inside your retirement accounts. Cashing out may trigger a stiff tax bill or steep penalties that could take a huge bite out of your savings. That's a setback you may want to avoid at all costs. Let's dive in and take a look at some of your options for protecting your retirement savings. Warning: you might be surprised about some of the traditional safe havens you had in mind. They may not be as safe as you once thought. One of the assets considered to offer its security is U.S. Treasury bonds. Even though U.S. Treasury debt is no longer AAA rated, it's still considered one of the safest investment assets there is. When things start to turn south, many investors have loaded up on Treasury bonds. But there are a few considerations you should think about, especially if you're trying to protect a 401k. First of all, U.S. Treasury bonds aren't 100% risk-free, and even though the U.S. hasn't defaulted on a bond in decades, doesn't mean that it can't happen in the future. The U.S. national debt is climbing into the tens of trillions, and interest expense on that debt is climbing as well, thanks to rising interest rates. At some point in the future, the U.S. government may face some real difficulties in servicing all of its debt. This may not be for a while, or it could be sooner than we realize. That's not all. The second consideration is that bond funds don't necessarily perform well during times of recession. For example, let's look at Vanguard's short-term and long-term treasury funds, VUSTX and VISX. On November 17th of 2022, the short-term treasury fund VISX was down 6.22% year-to-date, while the long-term fund VUSTX was down 28.69% year-to-date. Many bond funds don't always hold bonds to maturity either, so they're further subject to pressure from lower bond prices. And as investors look to unload poorly performing bond funds, that can put further downward pressure on bond prices. Also, if you have a 401k plan, you likely have a limited range of bond fund options. Look at yours and see how they're performing. And sorry to burst your bubble, but bonds may no longer be the safe haven investors once thought they were. Another option that has been considered safe is holding cash. If you've heard this before, you need to pay attention. When we talk about cash, we're talking about physical cash or cash equivalents, such as savings accounts or checking accounts. We'll talk about money market funds next. The higher inflation climbs, the lower your cash's purchasing power can fall. With inflation at 8%, that means cash holdings are losing nearly 8% of their purchasing power each year to inflation. The other problem with cash is that in order to buy it with 401k funds, you may need to take a distribution from your 401k. That means you could be subject to taxes, which could end up being 20%, 30%, or more, depending on your overall income and tax brackets. Do you really want to pay that much in order to hold an asset that loses money to inflation? Probably not. But don't worry, we have a solution we'll get to soon that could not only protect your retirement savings, but due to a little-known IRS loophole, you won't be subject to any taxes or penalties either. The other cash equivalent investment considered safe by fund advisors is a money market mutual fund. While they're treated as similar to cash, they're not actually a cash investment. Instead, money market mutual funds invest in short-term debt securities with minimal risk. If you have a money market mutual fund, you need to hear this. Money market mutual funds generally try to keep their share prices at $1, which is why they're often considered as a cash equivalent investment. Still, money market mutual funds aren't risk-free. Investment gains are minimal, as they're intended to be a loss-free cash equivalent investment for short-term investment purposes. As such, they'll lose value to inflation just like cash. The assets held by money market mutual funds are also not risk-free. Even if they're of high quality, they're still subject to loss. During the 2008 financial crisis, the Reserve Primary Fund broke the buck, meaning that the net asset value of its shares fell below $1. Panicked investors sought to pull out their money, and the fund was unable to make them whole and was forced to liquidate. Could this happen again? Money market mutual funds are also currently subject to liquidity gates and redemption fees, meaning that investors in these funds may have to wait to withdraw their money and may have to pay a fee to withdraw it during times of financial panic. If that wasn't enough, there's another risk to consider. Unlike savings and checking accounts, money market mutual funds aren't insured by the Federal Deposit Insurance Corporation, FDIC. So if the funds go under, there goes your investment. So much for being a safe haven, right? Now, let's get to the good stuff, the potential solution you've been waiting for. Unlike the other assets we've discussed, precious metals aren't an asset that just sits there not gaining value. Gold and silver move up and down in value depending on market conditions, but they have a history of performing well during times of recession and economic turmoil, which makes them popular safe haven assets. During the stagflation of the 1970s, for instance, gold and silver both made annualized gains of over 30% over the course of the decade. During the 2008 financial crisis, gold gained 25% during the same period. Markets lost over 50%. In the aftermath of the crisis, gold nearly tripled in price, while silver more than quintupled. That's why more and more investors are looking into buying gold and silver to protect their assets today. And one way they're doing that is through a precious metals IRA. A precious metals IRA is an IRA account that holds precious metals, coins, or bars. It's exactly like any other IRA and is subject to the same rules and regulations. Precious metals IRA investors often choose to set up a gold IRA that holds gold and silver coins and bars, or a silver IRA that holds silver coins and bars. One of the advantages to a precious metals IRA is that it can be funded with a rollover or transfer from an existing 401k, 403b, TSP, IRA, or similar retirement account. And due to a little-known IRS law, you can do this tax and penalty-free. So, you get the benefit of owning gold or silver to potentially protect your money while not having to take a tax hit by distributing your tax-advantaged retirement assets. It can be a win-win. So let's talk about your best options. The decision about where to move a 401k before a recession is a personal one that you as an investor will have to make, taking into account your own financial situation, your financial goals, and your appetite for risk. If you decide that a precious metals IRA is the safe haven for you and your hard-earned retirement savings, Goldco's representatives are standing by, ready to help you. With over $1 billion in precious metal placements, Goldco has the expertise available to help you protect yourself with precious metals and a reputation for customer service that is unmatched in the industry. Don't let the assets you've worked hard for years to accumulate lose value during a recession. Call Goldco today and start taking the first steps toward protecting your investments with gold and silver. If you would like to continue to learn more, watch this video about the future of gold investing.